Let's make stock market indices super simple. Think of an index like a highlights playlist for the market. Not every song, just the top tracks that represent the vibe. A market index tracks how the market moves by using prices of a selected set of shares. These shares are a representative sample, picked for size and liquidity so investors can copy them easily and cheaply. Most big indices are weighted by market capitalization. Translation: bigger companies count more in the score because they have more shares out there and sit in more portfolios. In India, the big three are NSE's Nifty 50, S&P, BSE, Sensex, MSCI's SX40. Sensex, its 30 chosen BSE stocks, market cap weighted. Nifty 50, 50 of the most representative stocks on the National Stock Exchange. SX40, 40 representative names on the Metropolitan Stock Exchange, all picked on liquidity, free float availability, market cap. And yes, the list changes over time to stay relevant to the real market. Narrow indices usually include the most actively traded shares, but there are broader ones too. Nifty Next 50, Nifty 100, Nifty 500, S&P BSE 100, S&P BSE 500, mid-cap, small-cap. There are also sector indices for banking, IT, pharma, FMCG and more. Great if you want to track a specific slice of the economy. Why do indices matter? They let you compare stock market returns versus gold or bonds. They're benchmarks for active funds and your own portfolio. They signal how the economy, or a sector, is doing. They reflect real-time market sentiment, and they're the foundation for index funds, futures, and options. Bottom line, an index is a clean, low-cost scoreboard for a messy, noisy market. If you understand the index, you understand the game. And once you understand the game, you can choose how to play. Like the market, track the index. Want to beat it? Now you know the bar. That's the power of indices.